Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have a conversation with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Catherine Tindall. She is a CPA and partner at Dominion Enterprise Services, a concierge tax advisory practice. And in just a minute, we're going to speak with Catherine about how to get the most out of your CPA relationship and some general tax planning strategies for real estate investors. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you'd like to see how attractive our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest. Catherine, welcome to CRE PN Radio.
Thank you so much for having me, Darren.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, so I'm a CPA. My practice is located in Greater Boston, but we serve clients all over the country. The firm's called Dominion Enterprise Services. We work with real estate investors, real estate professionals, self-employed individuals, people who own businesses, because the primary focus that our practice has is tax planning work. So we work proactively with clients where we know we're going to be a profit center for them by generating creative, out-of-the-box tax strategies that are able to, have 5 to 6 figures of impact for our clients. So that's a bit of our background.
No, got it. That's perfect. And so speaking to the like a real estate investor or real estate professional, what are some, I guess, kind of some good guidelines that you can suggest as far as identifying or picking a CPA that can best serve a real estate professional or real estate investors' needs?
Yeah, so it's a common problem that I see real estate professionals and investors have, is that the relationship that they have with their current professional is not what it should be for what they need. And I think for a lot of people, they don't take a step back and think, when tax is wiping out 20 to 50% of your income, that relationship of managing that really big expense it's important to have that be strategic and have that really be working for you. And so I think the best piece of advice that I can give for people when they're looking out for a tax professional is because we're so technical CPAs, it's hard to judge the quality unless you also know a lot technically about what goes on in tax. But I think for people having more of the mindset in those relationships of, is this professional someone who's just trying to get my tax return done, just trying to keep me compliant with a filing requirement? Am I, one of hundreds of clients that this individual person is serving? Or is this person more an advisor? And that's how they position themselves. And that's how they position what their service is, that they're interested in doing more, they're interested in being proactive. Because I think more than anything, it's if you have that level of complexity where you're getting heavily involved in investing in real estate investing specifically, the tax ramifications are so important as part of being able to really get the best out of your investments, that by having that proactive relationship, you're really going to be able to get a lot more out of your tax professional, and it'll turn quickly from it being an expense to you to it being something that is going to, generate more, wealth for you, because you're taking advantage of everything you're eligible for, which for real estate, anyone involved in real estate, there's just a lot available in the tax code to be taken advantage of.
Yeah, I mean, that's one of the great appeals of real estate is the tax treatment.
Mm-hmm.
So when you mentioned kind of, are you just a report they've got to get done to get filed by a deadline? My words, not yours, but versus an advisor. From an advisor standpoint, I'm assuming, is that kind of where you guys try and um, is that where your practice is focused on, is more of the advisory role?
Yeah, so we've really shifted. When I originally founded this firm a couple years ago, after working at other CPA firms, I realized that there was just in a lot of the client relationships, there were a lot of things that were broken, and that there was so much money being left on the table by the clients just because of the nature of the relationship. And so part of what pushed me to have the firm have more of this proactive advisory focus was so that people could really take advantage of all of the things that we knew how to do, and how to really strategize things. Because I think for a lot of people that I've encountered who come to me from other tax professionals, they're not even aware sometimes of things like doing cost segregation studies, or when's a strategic time to do a 1031 exchange, or even for people that are more in like the fix and flip area, can you take advantage of the personal resident exclusion, if you want to live in a property and upgrade. They're just not even aware of a lot of the basic strategies that are involved around real estate, because they don't have, they haven't had that kind of relationship with a tax professional.
Yeah, no, I'm sign me up as having had those conversations and realizations.
Mhm.
We have some investment properties, and I remember mentioning to my former CPA about cost segregation study, and it was basically like, well, you can do it, but you're not a real estate professional. You won't be able to
Yeah.
take advantage of any additional
Yeah.
um, write off, and it was basically just kind of left at that,
Hmm.
and but then as we acquired another property of new CPA, and ran into a tax situation that was going to be punitive, and I was like, holy crap, what about this? And I don't know that he had ever done one before, but he was open to it, and we did get a what is it, a cost segregation study done, and
Hmm.
I was like, that's a huge thing. I mean, I can't believe all the people that may know the word, but professionals like yourself that aren't really attuned to it to really know the benefits of something
Yeah.
like that. It's just a huge,
Oh yeah.
huge different. I mean, a way to do it. So,
Yeah.
but no. So do you have any kind of a regular schedule that you guys try and review things with your clients, or is it more of um, you know year end as needed during the year?
Hmm.
Uh, how frequently are you in touch with your clients? And I'm assuming that varies based on what they're doing, but it just is
Yeah.
kind of a general rule.
Yeah, for the most part, we like to engage with clients where they've got enough complexity going on where quarterly meetings make sense. And it depends, because some people, they'll have years where they're kind of in a set it and forget it year. They're not doing any deals. It's all very, run of the mill. Other times, you can hit, like during COVID, we had a lot of people that were doing a lot of deals quickly to take advantage of hot markets and everything. And, um, so it just depends on what people have going on. But I think kind of the thing that you mentioned with the difference between like the tax professional who, you know, they're just trying to meet a filing requirement and make sure that you're meeting your obligations with the IRS. And that's a good thing. Like, I don't knock that, that's what we do too. But with real estate, it's just so much more fun because you've got all these chess pieces to play with. And it's almost more like a game, and you can really strategize around it by doing stuff like those cost segregation studies, or accelerating depreciation in other ways, and taking advantage of like different entity structures and things like that. So I think that's just what it makes it more fun for the investor, and it's a lot more fun for the tax professional. And that's more kind of the relationship of the chess game.
I was going to say, fun and taxes don't always enter into the same conversation or the same sentence, but having fun planning to take advantage of some of the opportunities, or what you can do to minimize your tax, it makes sense.
Mhm.
Um, so the ideal kind of a situation for you or a client. I mean, do you have clients that are kind kind of just starting out? Do you have clients that are, seasoned? Where do you range on that?
A lot of the people that we encounter, they're kind of a mix. So we get some that are fairly well seasoned. They've kind of leveled up out of their existing relationship. They need, they have more moving pieces. They have more wealth they're trying to protect. But we also get a lot of people where they started out in, say, like a high earning W-2 job, have realized how much they were losing in tax just or earning their income that way, wanted to shift more into real estate, and then are now transitioning to, like, that's how they're building out their wealth. And we also get a mix of people too, where they start off maybe having a closely held business that they run where they're self-employed, but then they want to transition to more passive wealth building through growing their real estate portfolio. And if you have a taste for it and a knack for it, it's just a wonderful strategy to build wealth, really tax efficiently. And so that's kind of the range of people that we serve.
I'm curious. You mentioned high income earner, W-2 employee. Somebody that's not invested in real estate in that kind of situation versus having, changed or gotten into real estate and been able to take advantage of some of the tax advantages that real estate offers. Can you give kind of an estimate as to what you would expect their tax, I guess their net tax rate to change from to, if they, or is that too wide open?
I've seen people go from being over 50% to 20%. Just by, because it all depends on the character of how you earn your income, right? So
Right.
For people who are on a W-2, every dollar that you earn from your employer, you're going to have a certain amount of that's going to get taxed with payroll taxes. And then on top of that, you're also going to have it all come in at your ordinary income bracket rates, right? So those scale up really quickly. It's really easy to, all of a sudden you find yourself in a 30-something% tax bracket rate. And then on the state side, if you're in a high income tax state, like if you're in New York or California or any of those places, you can be well over 50%, just through having a W-2 job, versus if you can switch it to the real estate, you can drop that down significantly because you can take advantage of things like depreciation that produce kind of a paper loss, but you're still getting a positive cash flow. And the nice thing with real estate is you can time how you're earning your income. You have a lot of control over when you're going to do deals. You have a lot of control over, the character of the properties that you're picking up as part of your portfolio and what you're doing with them, and how you're making the investments. And if you're going to make improvements to them, you kind of have all the pieces. So you can really strategize how much income you're earning in each year based on what you have going on, versus if you're an employee, you really don't have any control on how that money's, going to come in and get taxed, because that's just how the tax code's written for employees.
Yeah, no, the control you mentioned, I hadn't thought about that, but I guess the option, if you, if you wanted to postpone the sale till next year, as opposed to close it before the end of the year, to give you some additional time to plan if you need to, that makes a lot of sense. One of the things that you didn't mention, and I was just kind of curious what your thoughts are on the 1031 exchange, as an option to defer the tax from deal to deal. What are your thoughts on that?
Oh, it's a wonderful strategy. And I think it's one of those things, sometimes it's worth it to pay the tax. It depends on your liquidity needs, but if you're in the long game, it's a very good strategy. And basically, a little background for anyone who's not familiar with the 1031 exchange. It's a specialty area. It's a specialty section of the tax code, which allows you to, you have to follow a lot of rules, and you have to use a qualified intermediary. So you can't just, DIY it. It's something that you do have to have professionals involved with, and it has to be executed a certain way. But the basic benefit of it is you can take a property, sell that property, exchange it into a like kind property, and not have to realize the capital gains on the appreciation from that property that you had bought. And so you kind of push everything into that new property, and then you can continue to do this over and over. So as you have properties that are appreciating, or you want to, change geographic locations of where you have your portfolio, or, any number of things, it's a fairly flexible vehicle for you to be able to keep, growing your wealth and, realizing those appreciations without having to trigger income tax. That's, going to really, eat quite a chunk out of the principal that you have, you've grown in those properties.
Yeah, no, it's funny because I've always had kind of a longer view of investing and always thought the goal was to build a big enough, nest egg or machine that
Mm-hmm.
would continue to create revenue to where it wouldn't erode
Mm-hmm.
the principal, which a lot of times when I look at like a 401k, I mean, basically it's a savings plan, and the you know the idea is to get you just about a day past you die, and get it to zero. There's not like
Yeah.
this, it's not really a plan to get it beyond that, or at least that's
Mm-hmm.
not really the intent. I think, they want
Yep.
their tax period. Um, but on the 1031, I'd run into some people that were like, I don't really believe in that. And I was like, wow, I don't understand. But it occurred to me that if you're basically you're getting in and getting out, basically flipping properties, whether it be, single family or multi family properties or what have you, and you're only in it for a year or two and you're out, uh, out slow enough to take advantage of the capital gains tax rate, but
Mm-hmm.
fast enough that you don't really have a whole lot of depreciation, um, built up. I was going like, well, I guess it does. I can see how it's not as advantageous for somebody that's in and
Yeah.
out of something right away. But if you've been in something and you've used up, was it 27 and a half years of depreciation on residential, and was it 39 on
On
commercial?
commercial. Yep.
So if you've used up a large percentage of your depreciation and the property is appreciated, that can be a pretty significant. I guess it's not all tax, but just, I mean, it seems like you're eating up a lot of that you could reinvest into the next deal,
Yeah.
and continue to leverage your, I don't know, your to leverage your equity to then get into a larger and more profitable property. But anyway,
Mm-hmm.
it was definitely an eye opener for me to see somebody that was like anti that and to kind of understand that. Do you have any kind of a sense of number of years, or where do you look? Is there a time horizon where you recognize that a 1031 may or may not be
Yeah,
appropriate?
it just depends too on the rest of what they have going on in their portfolio and what's going on in the rest of their income kind of tax life. Because for some people, if they're just doing one deal, it's a smaller deal, and they haven't been in the property for very long, it's not that much of a hit to pick up the capital gains on it, because at certain, bracket rates, you can take advantage of, there's a certain bucket that fills up at 0%. There's a certain bucket, that's 15. And so it's more just comes down to the overall timing for the person. And I think the other consideration too, that you have is, there's a big difference between people who are in real estate where the property is considered an investment versus when the property is considered inventory. And so when it's considered ordinary income, and if they're doing fix and flips and it's really um, that kind of operation, that gets treated differently than, say, someone who invests in a multifamily, is planning on having it for 10, 15 years. They're just going to rent it. Maybe they're going to put improvements in it, strategically to get some more depreciation on years when they have high income from other places, or whatever the case may be. So it is highly individualistic when it's a good idea to do it. But I think that's the key with a lot of the tax strategies, is it's really highly dependent on what your goals are and what you have going on, and really taking the time to crunch the numbers to figure out if it's going to be advantageous, and just knowing the full exposure and the full cost of doing different moves.
Yeah, I know, and even just another thing I was thinking of, just kind of as you mentioned, kind of the timing in that. I know my mom's retired, and I think there was a farm sale a year or two ago or whatever, and just but how that sale, I mean, it spiked her income for that 1 year, and how that then had like, I mean, not huge effects, but she was commenting on how the like Social Security going forward is reduced because they recognize that you had a significant income event kind of thing, and but just across the board of of all of your income sources, or however you're accounting for your, just to really have a strategy as opposed to a surprise and find out you have a big tax bill when you weren't anticipating. That's, you know, surprises aren't good, I guess.
No,
Yeah,
surprises are
yeah.
no.
Don't want surprises.
Yeah. I think a big
So
one I see too with a lot of people, especially probably for like your mom's scenario, is if you have any kind of subsidized health insurance or anything like that going on, you can very easily disqualify yourself from government programs by just not having the income smoothed out over the course of, a couple of years instead of just having it all in 1 year. So there can be a lot of surprises that pop up when you have, an unusual income year.
yeah. Well, again, it was just like an eye opener to me, because I was focused on all these other aspects where I didn't realize all the related potential complications that um, that came about, kind of thing. But all survivable, but just more of a, what you expected versus what you got kind of thing.
Mm.
So um so I did want to just ask you briefly, there's talk about some of the tax changes. Any kind of a sense of what you think might happen with Congress? I mean, we're recording this in December 2021. Congress hasn't exactly really been a um, a real productive place, but there's always the talk of change, and I
Hmm.
think that the talk a lot of times kind of wears people out, before it actually happens. Do you have any
Yeah.
sense of any of the topics on the table as far as what might happen? Or
Well, so currently, this is recorded, early December. So obviously they're set to be voting on it around Christmas time. It might get pushed out to January. It's been tough because we've been basically they were supposed to originally have all this wrapped up back in September. So it's a snail's pace. And the thing that's a little difficult with it too is a lot of the provisions that are in there and that were originally proposed, things keep changing. The reason for that is the way that this legislation is getting passed is through a budget reconciliation. So it's not just straight tax legislation, it's all part of reconciling their budget. And so, in order for them to be able to pass it, they have to have meet certain requirements for the dollar amounts of everything. And that's why it's making it so volatile as far as 1031 exchanges were on the chopping block and now they're not. There was a lot of talk about increasing the capital gains rate for people earning over $400,000, and now that's gone. There's just a lot of pieces that keep coming in and out. But I think the main thing that people should take away from tax reform is that to keep a close eye on it. It's hard to predict if it's going to be retroactive or not. And to just, if you have have a good relationship with your CPA, I know for us in our practice, once we get the actual final legislation of what's happened, we're going to go back through our database and see who's getting impacted and reach out and make sure that we've done as much as we can to mitigate those negative effects from it. If it does get passed, and that's the hard thing to predict as well, because there is a lot of dissent in among the Democrats, who it's really the Democrats who are going to be passing it amongst themselves. And there's a lot of dissent internally in the party. And so that makes it hard to predict whether or not it will even pass in the first place, not even knowing, what specifically they're going to end up deciding on keeping or scrapping, because as of, the night before, they can change pretty significant provisions in the attempt to get it passed. So, but I think a lot of these kinds of things, like the 1031 exchanges coming under fire, the capital gains rates increasing, a lot of talk around getting rid of step up in basis, which is basically, when you pass away, your properties get kind of marked up to fair market value, so that if your next of kin sell the property, it's not like they have to pay capital gains on that piece of property the same way that they would, if you were to sell it before you passed. So that was under fire too. And so I think the main thing for people to keep in mind with a lot of those is that these are things that this particular party is looking at. And so as long as they continue to be in power, I think a lot of these areas are going to be continued areas of interest. A lot of those kinds of motifs in the tax code and reform change are things that have been around since, the Obama administration. So just knowing that this is kind of in the mind of, this party, and as long as they're maintaining control, that these are things that might continue to come up and might continue to be areas of interest, I think is important for people to know.
Question for you. You mentioned retroactive. Is there a point at which they go past where they would not make it retroactive? I mean, if they don't vote on this until January, would that like they say, okay, no, we'll make it effective this year going forward, or is it just they're able to do whatever? It just seems kind of, double whammy if you think you're past it, and then, oh nope,
Yeah.
I mean, you haven't filed taxes yet for the year, but still,
Yeah.
it'd be nice to be able to plan.
Mm-hmm.
Is there any kind of a line that they follow as far as when they will not make it retroactive?
There's Supreme Court precedents for Congress being able to make retroactive tax changes, which to me, it just seems really insane that you can go back. It seems like it should be a right that people are allowed to plan for their taxes, and that once the time has elapsed, you're only on the hook for what was law as of when you did things. But sadly, that is not how our tax code is written. And so, I think some of the original provisions, it was supposed to go back to September is when the changes would be effective as of. But, the best hope is that they don't do that, because there's going to be a lot of blowback if they do. But at the same time, it's always kind of weighted between, punishing people for putting in retroactive changes, but then also if they let people have the window to make the changes, you can cause a lot of market volatility and other economic issues can pop up. So I think those are the two things that they weigh. But no, they're not. I don't think that there's a particular statute of limitations how far they can go back, specifically. But so that's the fear, that it will be, retroactive in 2021 and get passed in 2022. I'm just hoping that they don't wait so long that we have to amend a bunch of tax returns at the same time. But that's, that is on the table.
Yeah, no, it just seems, I don't know, I could see just, more challenges than what we already have.
Yeah.
The other thing, so talking about the retroactive, the unintended consequences. You mentioned, like, if they pass something, then there's all sorts of market activity. If they're, and I guess if they got away or did away with a step up in basis, would not putting property in a trust, would that not be your vehicle? I mean, if that was the new move, to where they say, aha, we got you, we're not going to give you the step up in basis, would that not be kind of like just a door open for trust business? It just seems like that's kind of a one of the appeals about real estate.
Yeah, and I think that's highlights part of some of the futility and some of the tax changes, just because there's always other ways to do things. And, between estate planning and tax planning, once we have kind of a new rule book with tax reform, it just becomes now another game of okay, so here's what we have. How do we best leverage this based on the rules we have to follow? And where, are there loopholes that we can take advantage of that are in the law? What are the opportunities here? And then what are the opportunities in someone's particular situation that they can take advantage of? Like, do they have, close family members that we can shift things to? Can we take advantage of things like family limited partnerships? Can we take advantage of trusts and gifting strategies? And so that just becomes, it just forces both, the tax planner, myself, and the estate planner to reassess the situation if we have, all of a sudden the game has a bunch of new rules in it. So that's what I'm anticipating. If there's, major changes that happen, it's just, you have to kind of reassess everyone's situation for a new set of rules.
A new game. So interesting. Well, it sounds like your job security is pretty good. I mean, as far as, what's funny is, when people have basically a W-2 and no write-off kind of thing, or very little write-off, it's really a pretty vanilla kind of thing. But once you do get into real estate and you have multiple schedules and multiple properties, and I can't imagine somebody trying to do it themselves. I know people do, but I was like, I don't understand why you would try to do that when there's somebody like yourself that studies that and swims in it every day and knows the ins and outs and can recognize an opportunity to give you a chance to keep more of your money rather than have to just write a check, I think. So,
Mm-hmm. Yeah.
But anyway, hey, Catherine, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and one of the things we try and do is manage risk with our clients, and there's a couple of strategies we look at when we're trying to manage or do risk management. The first we look to see if there's a way we can avoid the risk. The second, if we can't avoid it, we look to see if we can minimize the risk. And then if we cannot avoid nor minimize the risk, we look to see if there's a way to transfer the risk. And that's what an insurance policy is. And I like to ask my guests if they can look at their own situation. It could be your clients, interest rates. It could be the legal climate, potential tax law changes, however you'd like to frame the question. But I'd like to ask you, what do you consider to be the biggest risk? And for clarification, again, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Catherine Tindall, what is the biggest risk?
I say, the biggest risk that I see just from my professional perspective of the kind of cases that I diagnose and deal with on a day-to-day basis, the main area of loss I see for people is that they do a set it and forget it strategy when it comes to dealing with their tax situation. And a lot of people, because it's so technical, they don't have a way of assessing whether or not they're doing everything that they can, unless they're going to take the time to learn how to do it themselves. And so I'd say for most people who get involved in real estate, or who get, start having a lot more going on economically, that it's worth it to take the time to reassess your situation, get a second set of eyes to make sure that you're not missing out on things, because it can be 20 to 50% of your yearly effort. You're kind of working for the government, right? If that's how you feel with, paying your tax. And so to just not re-examine that every once in a while, you can really be losing a lot of the effort that you're putting in just for, things that are very easy to change, like just filing paperwork for splitting out entities, or adding a kid to payroll, or things like that. So that's what I see as the biggest risk. And a lot of the times, once those things are set and time's gone by. Sometimes we can go backwards to save the tax, but more often we can't. It's once it's done, it's done. I had someone recently where they tried to execute a 1031 exchange on their own, and they didn't do it correctly, and they didn't meet the timing requirements involved with it. And so they ended up with like over $200,000 in tax that could have been very easily deferred. They were aware of the strategy, they had an intermediary involved, but they just didn't execute correctly. And so I think that's the biggest risk I see for people is, to try to DIY too long, or to just set it and forget it, and not realizing that it's another area of being able to really maximize your wealth is being more strategic with, that tax number.
Yeah, the DIY 1031 exchange, not an option. That's
Nope.
not a good strategy. Wow, that's too bad. But no, I appreciate you sharing that, because it's so true. I think myself included like to, quote, set and forget it, but forget that, looking a little bit forward, you can do a lot of preparation to make a better landing than a crash landing. So that's good. Catherine, where can the listeners go if they'd like to learn more or connect with you?
So 2 good places. I keep our website, Dominion Enterprise Services. It's dominiones.com. We have a lot of resources on there. Very often my partner and I will post, we'll chat about tax topics, tax planning ideas. We have some tools on the website for, assessing eligibility for credits, things like that. But another good place to connect is on LinkedIn. I'm fairly active on there and post, updates with what's going on with tax reform and different thoughts that I have and situations that I encounter and planning ideas and those sorts of things. So those 2 places are the best to get connected.
Got it. Catherine, I want to say thanks for taking the time to talk today. I've enjoyed our talk. I learned a lot, and look forward to doing it again soon.
Yeah, thank you so much, Darren. It was an absolute pleasure.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.